Hello, my name is Spencer Gray, President and CEO of Gray Capital. Gray Capital's changed our current market outlook, and we are taking a more defensive posture given the current capital market and uncertain macroeconomic conditions. As President and CEO of Gray Capital, I felt like it was imperative that I communicate this position as it affects our current acquisition strategy. I also wanted to explain how we've arrived at this position and what it means for future Gray Capital projects in the Gray Fund. I'm at my core an optimist, continually being inspired by human innovation, collaboration, and the entrepreneurial spirit. However, there are new risks facing markets, and the way that Gray Capital and other private equity real estate firms and syndicators have structured acquisitions over the last 2 years is the wrong strategy for the near-term environment. These risks, to be clear, have nothing to do with the underlying fundamentals for multifamily apartments and are entirely related to capital market volatility, inflation, the Federal Reserve, and central planning. Gray Capital will continue to pursue high-quality, cash-flowing multifamily assets in growing and secondary tertiary markets, primarily in the Midwest. However, our approach will adapt to achieve an appropriate balance between risk and return. To be clear, the growth in multifamily is incredibly compelling, driven by historic imbalance between supply and demand, further accelerated by inflation, demographic shifts, housing unaffordability, and demand from investors. However, one can have the right thesis and execute with the wrong tactics. Doing deals like we have been, which has been in a declining or relatively flat interest rate environment, invites unnecessary and non-linear risk to a solid investment thesis. The biggest threat and risk in real estate, especially as a passive real estate investor, as a limited partner investing in syndications, is sponsor complacency and inexperience. Here's just a couple reasons why. Syndicators are solely focused on raising capital and winning deals, not necessarily on risk management. Using the current historic levels of rent growth as a new normal, projected for years into a pro forma, without accounting for expense inflation, is incredibly short-sighted. Using short-term floating rate debt without an interest rate hedge invites nonlinear risk. Betting on stable supply chains and labor markets for heavy value-add projects to deliver or to be rescued by another 20% of yearly organic rent growth and further cap rate compression, they're relying on all these factors to accomplish their business plans for them. And then newer or inflexible sponsors may use higher leverage due to either capital limitations or just indifference, rather than choosing a level of leverage appropriate for the risk. Gray Capital was not founded by Alex and myself with near term in mind. We endeavor to build an institution that will evolve and persist beyond us. And this goal requires thinking in decades rather than quarters, and will only be achievable through the preservation and the amplification of our partners and our own capital. Now, Gray Capital, we have 3 core tenants, and for each of those 3 core tenants, we have 3 subtenants below them and another 3 subtenants below them. Without giving you an entire list, our 3 core tenants at Gray Capital are purpose, integrity, and progression. Now, under progression, there are the 3 subtenants are vision, perception, and adaptation. Under vision, we have past, understanding, history, present, the current environment, the future, trying to understand what the future may hold. And then perception. We have empirical, trying to look at the truth in the data, extrapolate, trying to understand and analyze that data. And then intuition, using our gut and our sense of the world to guide us. Now, under adaptation, we have flexibility, never be comfortable, and always ready. It is these values that guide us, and with them in mind, I wanted to examine some of the factors that have led us to our current posture and the steps that Gray Capital is taking to mitigate these risks. So let's talk about the risks. Inflation is at a 40-year high, driven by an unprecedented increase in supply of money, record demand, and constraints across the supply chain that increase scarcity. The war in Ukraine is causing a variety of first and secondary inflationary pressures that appear to be catching central banks off guard for the moment. Beyond Ukraine producing a significant amount of the world's wheat, other input costs of food production such as nitrogen, potash, and gasoline have all risen dramatically. Farmland has also increased in value significantly in just the last several months. This specific price pressure was not the accelerating variable it was prior to Russia's aggression in Europe. Most central banks and many economists were predicting growth to quickly taper off in 2022, assuming a sharp reversion to the mean and more of a transitory level of inflation. Yet, another black swan has emerged, and it would appear that many are becoming numb to the unprecedented and historic events of massive consequence. Bowing to political and societal pressure, the Federal Reserve may purposely or inadvertently manufacture a recession to bring inflation in check by raising the Fed funds rate and selectively unwinding their balance sheet. The Fed's endeavor of tightening monetary policy using the tools they have may only be partially effective, if at all. Most of the causes of current inflationary pressures are outside of the control of the Federal Reserve, such as supply chains and the war in Ukraine. Other problems, the Federal Reserve is the primary culprit in its self-manufactured. The Fed has no real interest in reversing course on its past actions, such as propping up the stock market and real estate. The Federal Reserve will most likely not dump their holdings of mortgage-backed securities wholesale, as there are just not enough buyers in the market, and the housing market has been deemed too big to fail post-2008. The yield curve between the 10-year Treasury and the 2-year Treasury inverted March 30th. Further indicating a recession within 18 to 24 months. However, interest rates may likely fall after a recession. Let's discuss the nonlinear risks. Interest rates don't typically move too quickly. However, the 10-year Treasury, which is often driven more by market forces rather than the Fed funds rate or the Federal Reserve, quickly moved from 1.7% in March 1st, to just under 2.5%, almost 100 basis points move by March 25th. Today, as the recording, April 5th, the 10-year Treasury is above 2.5%. Also, in March, the Federal Reserve announced a forecasted, yet rather tepid, 25 basis points or 0.25% increase of the Fed funds rate. Now, cap rates, the measurement used to determine commercial real estate valuations, all at the same time are all-time lows. 4% and below cap rates are the norm, which when the 10-year Treasury was only 0.5% or less, made some sense speaking from a technical perspective, especially when combined with the strong rent growth. However, with current long-term interest rates between 4% and 5%, many assets will be acquired with negative leverage. Buyers using floating debt, attracted to initially low interest rates and higher leverage, may be in a perilous position if SOFR, which is the secured overnight financing rate, which is primarily used to finance multifamily apartments on floating rate loans, and is much closer linked to the Fed funds rate, rises more rapidly than the Fed is currently communicating. It may. Currently, SOFR futures are hovering around 1%, and the median projection of the Federal Reserve Board of Governors places the long-run rate at 2.5%, with rates ranging between 1.25% to 3.1% by the end of 2022. That means that rates on multifamily mortgages that use a floating rate based on SOFR could more than double by the end of the year. Many multifamily syndicators, accustomed to a less volatile and declining interest rate environment, are not assuming that their debt service may double in the first year of operations. This could lead to some projects not being able to service their debt. The potential volatility in short-term rates creates an extreme exponential risk profile for using unhedged floating rate debt in the current environment. Now, I'd like to talk a little bit about some of the organic hedges and maybe the other side of this discussion. The counterweight to the above risks is the established observation that rents outpace inflation. And interest rates are only rising with inflation. The price increase of debt and rent will cancel each other out at a minimum. The general premise is true, and if you bought last year and you have reaped the benefits with incredible growth with lower rates, providing a degree of headroom and an increased margin of safety. I think this is true for many of the assets that Great Capital purchased over the last year. Inflation also devalues debt. Higher leverage may increase risk, but should be offset by growth, at least theoretically. The risk remains that due to extraordinary low cap rates, some multifamily buyers will speculate incredible growth beyond reason while continuing to assume the interest rates of today, or even worse, the rates of a few weeks ago. To hit returns that many investors have grown accustomed to, syndicators may take exponential risk that does not justify a slight increased return. Mistakes will be made by simply not adapting to a changing environment. Now, there are other factors that will hopefully keep the U.S. economy moving and will not cause a deep recession. And to be clear, I don't believe we'll see a deep recession, rather a quick one. The U.S. consumer is in an incredibly healthy position with record saving levels, high home equity that's based on fixed rate debt. While wage growth is not keeping up with inflation, to be clear, we are seeing some of the fastest wage growth we have seen in decades, with unemployment at record lows. Indianapolis, for example, hit an all-time low in December of a 1.2% unemployment rate. So this all begs the question, is now not the right time to invest in apartments? I asked myself this question. Even though my business is focused on acquiring cash-flowing multifamily assets, I primarily see myself and Gray Capital as a steward of our partners and our own capital. The answer remains the same, however, that the incredible supply and demand imbalance of housing, combined with investor demand for uncorrelated and less volatile assets, will continue to support and lead to future growth. It would be healthy to see cap rates normalize upwards slightly, with prices still increasing due to continued revenue growth, or possibly flatten over the short term as capital markets disrupt acquisitions. As conditions do normalize, I anticipate a continued slide downward for cap rates due to incredible demand from domestic and foreign investors for stable U.S. multifamily. The simple answer is that apartment values will be higher over the medium and long term, and since we always take a long-term outlook, today is still a better time to invest than tomorrow. Now I'd like to discuss mitigation and how we're adapting to this environment and what we're doing. To take advantage of the future growth opportunities in the multifamily market, we must approach the task in a way that mitigates the current risks and uncertainty to achieve the most appealing balance between risk and return. And to do so, we are structuring acquisitions and projects in the following way. Using fixed interest rate loans with 7 to 12 year terms is our preferred financing strategy. Any floating rate debt must be hedged with a rate cap or similar, but we are not preferring to use floating rate debt at this time. If we would, underwriting models should assume the highest rate we would pay. Longer term hold projections will be used, 5 years minimum, with 10 years being the ideal. But with a strategy that allows for flexibility, that allows us to refinance earlier or even exit earlier if market conditions are ideal. We also will be using lower leverage, as low as 55% loan to value, with really kind of a higher range close to 70% loan to value, at least in the current market. Invest in markets that are not heating up. Midwest secondary and tertiary markets remain ideal conditions to not be oversupplied. We want to avoid negative leverage, and then identify opportunities to efficiently add value and enforce appreciation, not strategies that will be held up due to supply chain issues, but opportunities that we can quickly move in, force appreciation, and provide additional headroom and equity to a project. So what does this mean for returns? Taking a more defensive approach may lead to lower projected returns. We are standing by our total return criteria, targeting 15% and more IRRs and 2 times equity multiples over 5 years. Our cash flow projections for future acquisitions have decreased due to lower cap rates and interest rate spreads. Average cash on cash returns are still averaging 8+% over a 10-year hold compared to a 10% average a year ago. We are cash flow buyers and require cash flow at acquisition without speculation. This may slow our pace of acquisitions to achieve this. Now, we want to prepare for opportunity. While I do not anticipate a real significant decline in apartment pricing, it is possible. The market may simply normalize and leave the insanity we've seen over the last few years in the past. But there's also a chance, albeit I believe small, that we could see declines in valuations. This could be an attractive buying opportunity for investors that were able to weather the storm, and for investors of projects like the Gray Fund, positioned and well capitalized to take advantage. And I end with The admission of, we don't know. We do not know. No one can predict the future, and this letter is the last thing from an attempt to do so. The potential lost opportunity costs of maintaining the same acquisition strategy that we used over the last 2 years, though, is relatively immaterial when compared to the risks of complacency and the desire to achieve just the highest returns possible on paper. Our more conservative approach may be unnecessary and appear reactionary in hindsight, and that's a fact I am more than comfortable with. I do know that our current approach reduces risk significantly and greatly increases the chance of success that will ensure the preservation of principal. I appreciate you taking the time to watch this. You can read the full letter that should be available on the Gray Capital website, graycapitalllc.com. If you have any questions about our current position, our outlook on the market, or information about the Gray Fund, you can get in touch with us at graycapitalllc.com or email me directly, Spencer@graycapitalllc.com. Thank you.